In my 30 years of analyzing markets, I've seen many companies post good earnings. But rarely do I see a company post a perfect quarter, beating every metric, only to see its stock plummet 30%. Today, we are decoding the paradox of Tempus AI. Is this a falling knife, or the opportunity of the year? Let's dive in. Let's start with the hard numbers. Q3 was a historic turning point. Tempus delivered $334.2 million in revenue, smashing analyst expectations. That is an explosive 84.7% growth year over year. But the real headline isn't just growth, it's profitability. For the first time in company history, adjusted EBITDA turned positive at $1.5 million. This is no longer a cash-burning experiment. The business model is working. To understand why it works, look at the engine. It's firing on two cylinders. First, the genomics division, testing patients, grew a massive 117%. But look closer at the data and insights line. This is the high-margin gold mine. It grew nearly 38%, generating over $81 million. They didn't just run tests. They signed $150 million in new data contracts in a single quarter. That proves Big Pharma is hungry for what Tempus is selling. So, here is the mystery. Look at this chart. The green line is fundamental performance. Revenue is soaring. But the red line, the stock price, collapsed from a high of $103 down to the $70 range. Fundamental performance went up. Market price went down. Why the disconnect? It's not a crisis, it's a correction. Three things happened. First, buy the rumor, sell the news. The stock had already run up 50% before the report. Second, valuation. At its peak, Tempus was trading at 15 times sales. That is expensive. The market is simply hitting the reset button to a more sustainable level. And finally, we saw a sector-wide rotation out of medtech in November. The business didn't break. The price just got ahead of itself. Here is a question for you in the audience. Do you view Tempus as a medical lab, or a tech company? Let me know in the comments, because this distinction matters. Competitors like Guardant Health and Exact Sciences operate on a test-first model. They make money selling tests. Tempus is different. They operate a data-first model. They use tests essentially as a tool to acquire data, which they then license to pharma. They aren't just looking for patients, they are building a library. This library is their moat. Most companies have one piece of the puzzle. Tempus has all three: genomic data, the mutation, clinical data, what treatment worked, and pathology data, what the tissue looks like. They have linked over 9 million patient records to 4 million genomic profiles. This multimodal dataset is the fuel for the next generation of AI in medicine. Visualizing the financials, the trend is undeniable. Look at the climb from deep red to green. We went from losing $21 million a year ago to making $1.5 million today. And management is guiding for roughly $20 million in EBITDA for Q4. The inflection point isn't coming, it's already here. So, where do we go in 2026? Watch for three things. 1. Synergy. Can they cross-sell their new acquisitions like Ambry? 2. Reimbursement. If insurance starts paying for their AI diagnostics directly, margins will explode. And 3. Free cash flow. Moving from EBITDA positive to actually generating cash will be the signal for institutional investors to pile in. But, as a researcher, I must highlight the risks. First, watch out for stock-based compensation, SBC. If they are printing shares to pay employees, your equity gets diluted. Second, gravity. You cannot grow at 80% forever. If growth slows too fast, say, to 30%, the stock could get crushed. And finally, keep an eye on the FDA. Stricter regulations on lab tests could slow down their speed to market. I don't want you to just take my word for it. Here is your homework. For the next earnings call, fill out this scorecard. Gross margin. Is it above 60%? SBC. Is it trending down? Data revenue. Is it growing faster than the rest of the business? If these boxes are checked, the thesis holds. To summarize the story, we have a situation of explosive growth and profitability. A complication caused by a market disconnect and valuation reset. And a resolution where value will likely be driven by their unique data moat. Ultimately, it comes down to what kind of investor you are. If you want safety and cash flow, look at Exact Sciences. If you want pure play testing tech, look at Guardant. But if you are a growth investor willing to accept higher risk for an AI platform play, Tempus AI offers the highest potential reward. 3 final takeaways. The profitability inflection is real. The moat is the data, not the tests. Ignore the ticker noise, focus on the fundamentals. Please remember, I am a researcher, not your financial advisor. Always do your own due diligence. If you found this analysis helpful, I have a question for you. Do you think Tempus will hit its $20 million profit target next quarter? Type yes or no in the comments below. I'd love to see your predictions. And if you want more deep dives like this, please hit that like button, subscribe, and ring the bell so you don't miss our next breakdown. Thanks for watching, and see you in the next one.